What is up, you guys? Pete DiCarlo here, and today we're going to talk about how to prepare for a stock market crash or a stock market correction. Hit the like button, subscribe to this channel, hit the notification bell so you can stay up to date with all of these videos. And a lot of you might be asking, well, why am I making this video? Do I believe that a stock market crash is coming or a correction? The answer is yes. If you look at the S&P 500 over the past year, it has done nothing but go up. If we look technically at the technicals for the stock market, we will talk fundamentals, but technically, we keep bouncing off of this major support, but every single time that we bounce off this support, it is looking weaker and weaker. If we fundamentally look at the stock market, we know that, hyperinflation could continue to be a thing unless we start to raise rates. If we raise rates, then, overall, we're going to see less buying, we're going to see less lending, and overall we have this duality, this huge fight between raising rates and what the bad and good that's going to end up happening with it, and keeping rates low and the bad and good that's going to end up happening with it. And I can do a full breakdown if you want me to fundamentally on why I don't trust the market. Just comment down below and let me know. But I've had a lot of people within my academy asking me, how would I prepare for a potential correction or a potential crash? I don't think we're going to get a crash. I think we'll probably get a 10% correction, and the S&P will pull, or S&P 500 will pull back to like $400, which is about a 10% move. That's where I see this going to. Now, how would I prepare, and am I preparing? And the cool thing about this video is I'm going to go over not only how to do it as a trader, but also how to do this as an investor, because I feel like this channel curates towards both of those types of people. So when it comes to trading and investing, there are two phases or two modes that you need to be in at all times. The first one is capital appreciation. The second is capital conservation. This is not only just for the stock market, but this is for life, right? Capital appreciation is a phase in which your main goal is to grow your account and or grow your net worth. Capital conservation is a phase in which your main goal is to hold on to what money you have or take minimal losses. Now, like I was saying before, when it comes to your life, think of it in the sense that, like, if you're 23, 24, 25, your goal is not to hold on to what little money you have, because you probably don't have a lot of money. Your goal is to grow your net worth, to take risks, to build your net worth so that when you're older, you can conserve and hold on to that money. So if you're 65, you're not going to go taking your retirement and YOLOing it on crypto or something like that. You're going to focus on conserving what cash you have so you can retire and live off of that. Now, while you can do that in life cycles, you can also and should be doing this in market cycles. So for instance, capital appreciation mode is what I was really focusing on at the bottom of the 2020 crash. When Roni was kind of hitting that bottom back in April and May of last year, I was in a capital appreciation mode, and I have been in a capital appreciation mode from then up until about 2-3 months ago. When the market dumped back in 2020, I was in a capital conservation mode. I was trying to just hold on to any capital that I had, whether that was through hedging, which I can make a video on, or just, some of the things that we're going to talk about in this video. So you're always in one or two. And I'm going to talk about how to set up a portfolio for trading and also investing. So you're always in one of these two. You never really want to be completely out of the market, and I'll talk about that later on. So personal portfolio setup. When I'm in an appreciation mode, and this is whether it's stock market investing or long-term investing. Stock market trading or long-term investing. When I'm in an appreciation mode, I have 90% of my money in positions, 10% in cash. When I'm in a conservation mode or I'm feeling bearish about the market, I am in 70% positions, 30% cash. Now, a lot of you might be asking, if you're bearish on the market, why not sell everything and hold cash? Why would I not do that? Comment down below. I know that this isn't live, but comment down below. Why would you not do that? The answer is because if the market doesn't crash, which 9 out of 10 times when we expect a crash or expect a correction, I've been expecting a crash and a correction for the past 8 months, it doesn't happen. And look at the S&P 500. If you would have just done that back when we were looking like we were extremely overpriced, the S&P 500 would have pushed another 10 to 11%, and you would have missed out on all those gains over the past 8 months. So that's why I never personally, and remember, I'm not a financial advisor, so it's all just my personal opinion and what I do. That's why I never personally pull all of my money out of the market. I never do that because I always expect a crash or a correction. It never ends up happening. And so for me, I don't ever pull all my money out. Now, let's talk about investing examples. These two examples of an appreciation phase and a capital conservation phase, this is going to be for investing only. I'm going to save trading examples for the end. So let's say we have 100 grand. And of course, if you don't have 100 grand, scale all of this down. Even if you have 10 grand, you can just, do 1/10 of this. If I have $100,000 and I'm in an appreciation phase or an appreciation mode, I'm going to have $90,000 in the market and $10,000 in cash. When I say cash, I don't mean straight up, cash Benjamins underneath of my freaking bed in a safe. I'm not talking about that. I'm talking about $10,000 in my broker account sitting there straight cash. None of this is margin. None of this is leveraged. I don't recommend doing that at all, ever. I really don't. Now, I'm going to have $90,000 in the market. 10% is going to be in cash. Now, of the $90,000 that's in the market, 60% of that 90 grand or $54,000 is going to be in solid positions, or what I call life positions. So positions you'd hold for life. So, these are not examples you should use, but maybe something like Apple, Tesla, Microsoft, Amazon, Boeing, maybe Netflix, like these types of companies that are like staples that you don't care about holding for the next 5 years. They are going to be the bulk of the money that you have in the market. Then the other 40% of that 90 grand, so $36,000, you can use that for some spec. So if you want to go and invest in something like a NEO or something like a Palantir or like a fuel cell, one of these speculative companies, you can use that money for specs. Now, of course, if you're older, instead of having 60-40, you might want to do 70-30, 80-20. If you're younger, you could do 50-50, but I don't recommend going below 50-50. I think that you need to have staples be the majority, if not at least half of your portfolio, so that this way, if you underperform with your speculative investments, you're at least going to help to even out that yield for the year by those good investments. And maybe those, solid investments take a hit, but you do really good with your spec. They kind of even each other out. But I don't recommend going more spec than more solid, to be quite honest. Now, how would I run a conservation phase as a long-term investor if I don't feel good about the market, aka right now? I would have $70,000 or 70% of that money in the market still. This is important. Still, I would still have that money in the market. And I would take $30,000 or 30% and have that in straight cash. So cash sitting in the broker that if the market crashes, I can deploy that money immediately. That's how I would do that. Now, this is where it starts to get interesting, and I want you guys to stay with me here. So, of that $70,000 that I have in the market, I want you to have, personally, this is what I would do. 80% of that money, 80% of the 70 grand in the market, I would want to be solid positions, $56,000 worth. Now, what you'll notice is you actually have a little bit more of your solid positions, so more solid positions in the market during a conservation phase, right? And you only have $14,000 in speculative investments, so 20%. So 80%, and we're in this example, $56,000 in solid positions, or 20% / $14,000 in speculative positions. So we are really, even though we're having less money in the market, we're really ramping up on the solid positions. And the third thing is you can, in order to achieve this, so like let's say that you were initially doing this, in order to achieve this, you can, number one, add more money to the stock market, which a lot of people can't just add 20-30 grand. What you could do is pull profits from some stocks that you think are overpriced. So let's say that you have a stock that's up 1,000% in the last 3 years or 500% in the last 3 years. You could pull profits from something that you believe is overpriced, something you have a huge profit on. But what I would say is you don't have to close that position entirely. Like let's say that you put, for instance, like $5,000 in NEO 3 years ago, and now that money's worth 40 grand. You could just sell half of that position. However you want to do it to get to this is specifically what I would do. Because I wouldn't have a ton of spec if I didn't feel confident about the stock market or overall how we're doing. So that's how I would do it. Now, let's talk about trading. And trading's going to look a little different. So let's say in the same example, we have $100,000. Now remember, if you don't have 100 grand, you can just quickly do the math to figure out what it is. If you're, only have 10 grand, go ahead and use 1/10 of all of these numbers. If you're in an appreciation phase, which is what I've been in for like the past year, I would have 90% of your money in the market, 10% cash. So in this example here, if we have 90 grand in the market, I would use 60% of your money. So 60% of that 90 grand would be $54,000, and I would sell cash secured puts. If you don't know what cash secured puts are, go ahead and type, go check out my channel. Obviously, you're on it right now watching this video. You can just type in my name, Peter DiCarlo, selling puts. I have a bunch of videos talking about cash secured puts. Cash secured puts is the easiest way to make consistent income with the lowest amount of risk. Every single time you open one of these, which should be a couple times a week, you have an 80% chance, 90% chance of making money. So I'd be using the bulk of that money to sell puts. Then I would take 40% of that money, or 36 grand, and I would use that to trade shares or to trade spreads. And if you're really, really bullish on a position, trade straight up options. But I would really only use about 5% or $5,000 of that 36 grand to trade options. I really would. What this is going to do is that selling puts, right? If you're selling $54,000 worth of puts, you can very easily make $540 a week. So let's say like 1 week, let's say 1 month, you make 2 grand on your consistent selling puts, but you lose 2 grand trading with the rest of the money. You're even for the month. It evens each other out. Let's say that 1 month you make 2 grand selling puts, which should be very easy to do with that kind of money. You make 2 grand selling puts, but you made 3 grand trading. Well, now you're up 5 grand. So they help to level each other out. Sort of like in the investment example, the solid positions help to level out the spec positions. So that's what I do. That's what I really look to do. And I have about 75 grand in my trading account. I feel like I really don't need any more than that. So that's what I would be looking to do. Now, right, and once again, I really don't like options straight up. I'll be honest with you. I would say that of that, maybe max 5 grand, 4 grand, 3 grand to do that. Now, conservation phase of trading. This is where, if you guys are interested, hit the like button, comment down below. Let me know if you want me to do a full conservation, how to hedge, basically how to hedge a position or hedge your portfolio. I'll talk about that. Now, conservation phase for a trader. How does it look? For me, $70,000 and or 70% is still in the market. 30% or 30 grand in this instance would be in straight cash, ready to deploy in positions. Now, kind of like what we saw earlier, I'm going to have 80% of that 70 grand or $56,000 selling puts. So you can see here, before we were using 54 grand, now we have 56 grand selling puts. And these puts are going to be far out of the money. So instead of trying to make 1 to 2% return a week, I'm trying to make 0.5% a week or just stay even, right? If the market's really dropping, I could sell far out of the money puts, make maybe 0.5% a week on that 56 grand. Really, best case is 1% a week. Still not bad. Because remember, the goal is not to make money, it's to hold on to what we have. Then I would take 20% of that 70 grand, which would be 14 grand, and I would be trading small shares. So like maybe $4,000 or $5,000 worth of shares per position, and put credit spreads. If you're unable, I don't want to move that margin. I don't know what the hell it is. There we go. And I would only do these if they set up perfectly. Now, if you're unable to sell puts in a small account, right? So let's say you only have 4 grand, 5 grand, 6 grand, and you're like, dude, I can't sell puts. I don't have enough money to sell puts. So both your examples are worthless to me. What you can do is do what we're saying, but do put credit spreads instead. I have a lot of videos on this channel. If you go and watch, like, I think it's the 3rd or 4th video I put out before this one. It's called No Lose Option Strategy. That's put credit spreads. Go and watch that. I would say if that's all you can do in a conservation thing, because you have no money to sell puts or you don't have enough money to sell puts, what I would say is keep 50% liquid. Let's say you have 50 grand. I would take 2,500, keep it in your account, but don't trade with it, right? Then I would take the other 2,500 and do put credit spreads. I would only do a put credit spread if the position sets up perfectly. And I would only risk 1 to 2% of your portfolio per position. So let's just say that you have $5,000, 2,500, like I said, 50% is just going to sell on the sideline. So we have 2,500 to trade with. I'm not going to risk all 2,500 on one put credit spread position. I'm going to take $500 or $400 of that and use that to trade a put credit spread, which with a put credit spread, you have like an 80-90% chance of making money. So your chances of making money are still pretty damn good. Guys, I hope that this video wasn't too confusing. This should be a very easy way for you guys to really focus to like build your outlook on how you're going to trade or how you're going to invest in the next correction, whenever it is. If it's going to be in the next week, next time. Last time I made a video like this, we had the whole Roni situation. So, you know, whether that's going to be next week, next month, next year, whenever you're feeling bearish, don't pull your money out entirely, in my personal opinion. I would really focus on just kind of doing what we talked about there. If you want more videos on this, talking about how to hedge your portfolio, whether it's long term, short term, whatever it is, how to run a hedge, I can definitely help you guys out. Comment, let me know down below. Hit the like button, subscribe to this channel. I have a ton of free courses, a ton of free Discords, a free Discord server, a ton of free stuff. It's all down in the description. Thank you guys for all the support. Peace.